All right, let's talk about Dime Community Bank shares, ticker DCOM. They just dropped their Q2 2025 earnings, and on paper, things look great, a solid beat. But the market's reaction? Kind of lukewarm, to be honest. So, what's really going on here? We're going to dig into the story behind the numbers, figure out why management is so bullish, and try to understand this huge disconnect between their performance and the stock price. Okay, so here's how we're going to break it all down for you. First, we'll cover the headline numbers from their strong quarter. Then, we'll get into the real meat of the story, their plan for margin expansion. This is key. After that, we'll look at how they're pivoting the whole business into new areas. We'll also tackle that big question, why the market seems so cautious. And finally, we'll wrap it all up and give you our take with the next call.
All right, first things first, the results. And we have to start here because honestly, by pretty much every metric that counts, DCOM knocked it out of the park this quarter. They easily beat what all the analysts were expecting. So let's take their core earnings per share. It came in at 64 cents. Now that beat Wall Street's consensus by about 1.6%, which is nice. But the real headline here, check out the year-over-year growth. We're talking a 49% jump. That is some serious acceleration on the bottom line.
And it wasn't just earnings. The top line tells the exact same story. Total revenue hit almost $110 million. That's another beat, about 2.6% higher than expected. And compared to last year, a super healthy 22% increase. So this table really pulls it all together. Just look at that core pre-tax pre-provision income, up a whopping 75%. That tells you their core earnings engine is absolutely firing on all cylinders. But the number I really want you to focus on, the one that's the key to this whole thing, is the net interest margin, or NIM. It's up for the the fifth straight quarter, hitting 2.98%. And believe me, there's a huge reason why that's happening, and it's a catalyst that's just getting started. Okay, and that leads us right into the core of the bull case here. See, the reported results were good, yeah, but if you listen to the earnings call, management spent almost the entire time talking about something else. They were pointing to this almost automatic catalyst for future growth that they believe isn't even baked into the stock price yet. Yeah, the CEO, Stuart Lubau, he basically laid it all out. He said, and I'm paraphrasing a bit, look, our full earnings power, it isn't shining through yet because the asset side hasn't repriced. What he's telling everyone is that this strong quarter, it's just the appetizer. The main course is still coming because a massive part of their loan portfolio is about to get a whole lot more profitable. So how big are we talking? Let's put a number on it. $1.95 billion. That is the value of their loans that are set to reprice or mature in just the next year and a half. That is a huge number. So let's break down what that actually means. Right now, that almost $2 billion portfolio is making them about 4.1%. But any new loans they're writing today are going out the door at around 7%. So as those old, lower rate loans get paid off and replaced by these new, higher rate ones, well, management thinks that alone could add a full 30 basis points to their net interest margin. And get this, it's not a one-and-done deal. There's another $1.7 billion in loans doing the same thing in 2027. This is a tailwind that could last for years. And this chart just makes it crystal clear, right? On one side, you have what they're getting on the old loans, and on the other, you have what they could be getting in today's market. That gap, that's pure profit potential waiting to be unlocked. It's like a built-in engine for higher earnings, and it really doesn't depend all that much on what the rest of the economy is doing. But are they just sitting around waiting for this to happen? Absolutely not. They're actively changing their entire business model right now. In fact, management has this great phrase for it. They call it the tale of two balance sheets. So what does that mean? Well, on one side of the ledger, they're intentionally shrinking their commercial real estate portfolio, the CRE stuff. They're de-risking. But on the other side, they're hitting the gas on business lending. It's already up 15% this year. And they're moving into these new, more profitable areas. So you see, they're de-risking one part of the bank while supercharging another. It's a pretty smart pivot. And these new verticals they're getting into, they're pretty sweet. We're talking about things like corporate finance, lender finance, and fund finance. These can bring in spreads of 250 to 300 basis points over the benchmark rate, SOFR. Plus, a lot of them are floating rate loans, so if rates go up, DCOM makes even more money. And the best part? Some of these areas like subscription line financing are historically super safe, very low loss types of loans. So they're adding growth and quality at the same time. Okay, so let's just step back for a second. We've got a great quarter, a massive built-in profit driver, and a really smart business pivot. You'd think the stock would be flying high, right? Well, it's not. And that right there is the big mystery we need to solve when it comes to DCOM. So the big question is, why? If everything looks so good under the hood, why has the stock been such an underperformer? And I mean, just look at this chart. It says it all. So far this year, DCOM stock is down more than 7%. Meanwhile, the S&P 500 is up almost 11%. That is a huge gap. It's not just lagging the market, it's lagging a lot of its peers, too. Even the reaction to this great earnings report was telling. The stock moved up, about 2.5% pre-market. That's not exactly a standing ovation. It's the market basically saying, all right, that's nice, now go do it again. It's a total show-me story. Investors want to see that forecast for higher profits actually turn into real, in-the-bank earnings. Okay, so that brings us to the big finale. It's time to connect the dots, the good quarter, that huge repricing opportunity, the smart business pivot, and the market's skepticism, and give you our rating. It's time for the next call. Here's how we see this playing out. First, we're predicting that their net interest margin is going to keep expanding, especially in the back half of this year as that repricing engine really starts to roar. Second, we think that NIM growth is going to be the catalyst that finally gets the stock moving. The market's show-me attitude will turn into, okay, I believe you now, and that should lead to a re-rating of the stock. Our thinking is pretty simple. Once DCOM proves the strategy is working, it's going to start outperforming. So because of that very clear, catalyst-driven path to bigger profits, a path we think the market is totally sleeping on right now, our official rating on Dime Community Bank shares is Outperform. We just think there's a really good chance that as they execute on this plan, that big performance gap we saw earlier is going to start to close, and maybe close pretty quickly. All right, that's our take. But as always, please remember, this is for informational purposes only. You've got to do your own homework before making any investment decisions. This is not financial advice.